Welcome back to my channel. In this video, I wanted to go over the stocks that I think are the worst stocks that I could potentially buy. I think they're going to lose a lot of money over the next year to 2 years. Now, first, let me tell you about what my point of view is, the type of investor that I am. That way you could understand my comments a little better. So I'm an investor and I try to find companies that are discounted. And the discount is based on the value of the cash flows a company is going to produce in the future. I establish that value based on cash flows using a discounted free cash flow model that I'll show on each stock that I'm going to talk about. So that's the basis of why each one of these companies, I believe, is priced too high and is really setting up to revert back to its intrinsic value and, in essence, cause a lot of losses. So that's the basis of what I'm going to approach each stock with is that type of study, and I'll voice my opinions with you. The stock market has been selling off, and it's not about the market selling off and, hey, you should get out of the stock market. But there's always something to learn from things that happen. And what I'm currently learning is certain stocks are selling off because stories have gotten old. The AI story is really getting old. A lot of companies have invested in AI. We're not seeing real value, real economic value in the form of true revenue growth, profits, and so forth. It seems like every company is labeling their products as AI products. Now everything's AI. So it's hard to distinguish what was existing revenue, maybe legacy revenue versus AI revenue, truly organic AI revenue. So great companies like NVIDIA have just been shellacked recently. Amazon's down. I mean, some of these businesses are incredibly valuable. And the companies I'm going to show are not quite as valuable as these two examples, but I think they're really setting up to really go down in value. The first company that I believe the stock price is just way too high is Palantir. Palantir is a software company, and they take a lot of data and create analytics and create certain trends that help businesses make decisions. And in some cases, you could set up a workflow. They call it AI or machine learning to then trigger a particular activity. We've been able to do that in the software industry for 10, 20 years, by the way. It's not completely a revolutionary new idea. This has been possible for some time, but they do it really well, and they're really successful in selling to businesses. But the stock price has really gotten carried away. And let me show you the fundamentals. The share price for Palantir has really exploded. Over the last 5 years, it's gone up 734%. Now, I imagine that investors are feeling great that this has had such a great rate of return. If you don't own Palantir, there's probably a little bit of envy where, hey, couldn't I be a part of that type of performance and overall success? But it's also setting up to potentially really correct. This type of appreciation is not normal. It's incredible. Now, is it completely believable for a long-term valuation? Let's take a close look. So it's about a $195 billion business. So they're no longer a little cap that's just exploding because nobody knew about it. It's a big cap now. The revenue is not very high. So let's round up to 3 billion. So investors are paying upwards of 65 times revenue. That's expensive. That's just an expensive ratio. Forward P is 150. Again, expensive ratio. When we look at analysts and what they say, there's 18 analysts covering Palantir. And there's analysts that are bearish with the stock target at $80, going from $83 to $20. That would be roughly a 75% decrease to the stock price. So there are bears out there. And of course, there's some bulls that are saying, no, the stock can go higher up to $141 per share. I estimated the value of Palantir looking at their free cash flows and discounting those cash flows to today's value. I also looked at earnings per share to give them a little more of a balanced evaluation. So the cash flow for Palantir is positive. It's good. It's actually $1.1 billion. what I'm going to do is expect that they're going to be able to grow cash flows nicely by 30% in the first 4 years. That's a very high growth rate. It may not be possible. They may be light on those numbers, which would reduce the value of the company. And certain stories have come out. I know that the federal government is trying to cut cost. They're trying to reduce costs of the federal government, and that happens to be Palantir's biggest customer. So will they cut the budget of spend on software? Potentially. At a minimum, if people are losing their jobs in the federal government and they had a license to the Palantir software, they no longer need that license seat. We'll see how that plays out. But that's an example of if they have any kind of downturn in the business, the cash flows will go down. But for now, it's a very favorable forecast. So the first 4 years growing at 30%, and then a very generous 5% growth rate long term. That is a generous factor as well. When I discount all the cash flows I expect out of Palantir to today's value, I get $85 billion of value. I'm going to add cash and take away debt. I get to $90 billion. That's the maximum I can value Palantir. But they're trading way up there currently. So there's about a 52% premium on Palantir stock when I compare the value of the future cash flows the company's going to produce versus the current stock price. I believe over time, the stock price will revert, align with its intrinsic value. That's what stocks do. So we'll see how this plays out with Palantir. Let me show you the graph and what's been happening recently. Year to date, Palantir stock's actually up 10%. It's March 4th, before the market's opened. It's supposed to open down about 5%, so it's going to come down a little bit. But you can see that it hit a high point, and now it's down 33%. Now, the sell-off has been more market-wide. It's not just Palantir that's selling off. But this shows that, hey, investors are maybe cashing in big gains. No new inflows are coming in to match the outflows in this stock. So overall, this stock may be correcting and moving towards its intrinsic value. So Palantir is the first stock I'll put out there that I believe I want to stay away from because it could take my wealth and basically burn some of it. I'll lose money, and I'm going to avoid the Palantir stock. The second stock that I'm keeping out of my portfolio to avoid losing a lot of money is HIMS. HIMS was on a rocket ship ride toward the end of 2024 and into 2025. Stock just really flew up. And this is a interesting little company. They've accomplished a lot. But now that they're a little bigger and they're facing some new challenges, the biggest one now is that they really made a lot of money helping people lose weight. And they had a big benefit or opportunity where the actual pharmaceutical companies that have come out with a drug for diabetics that helps people lose weight, they couldn't keep up with the demand of the market. So the FDA allowed HIMS to produce that drug and, in essence, sell it on their website legally while the scarcity continued for that drug. Well, those scarcity issues have been resolved, and now only the pharmaceutical companies that own the patent are allowed to sell that drug. So it's going to take a important product off the HIMS portfolio. So they'll have to deal with that challenge in 2025 and 2026. So that's one thing that's happening. Let's take a look at their fundamentals and see what we got. HIMS is a small cap. It's a $9 billion market cap company, and the revenue is $1.5 billion. So it's a little more fairly priced compared to Palantir. The forward PE is high. 66 is a high PE. Shows that it's an expensive situation. In the 1 year, the stock's up 210%, and that's with a fairly big correction that's been happening in the stock here in 2025. So the stock just really cranked up at the very beginning of 2025, and now it's really gone off a cliff and come down. Let's take a look at the value that I've calculated for HIMS. HIMS stock has been selling off quite dramatically. Stock price is just crashing. And I still think the stock is priced 35% too high if we look at the free cash flows of the company. Similar to Palantir, I created a free cash flow forecast for the company with growth rates that were quite optimistic. And I just can't get to their market cap. And this is assuming they're not going to have a disruption to their business. If they have a lapse in growth, if growth is not as good on top line revenue, this stock is really going to go down in value. For now, it's just reverting back to what I believe is the intrinsic value of HIMS, which is far lower than its current stock price. Today, the stock's looking like it's going to open to the downside and getting closer to the intrinsic value. So the situation with HIMS is really dicey. The stock is down 7.57% in the pre-market. We're roughly about an hour before the market opens. In looking at the recent high to where the stock's trading at this moment, it's 40% down. And if you add that 7, we're going to be close to 50% down from its recent high. The high was on February 19th. Talk about a quick correction. This stock's really, really moving down. This is the type of stock I just don't need in my portfolio. My aim is to grow wealth, to outperform the market, to just consistently, year after year, make great gains and increase the value of my shares, increase the value of my portfolio. Buying a stock like this at the wrong time is a wealth destroyer. This could really take an investment. Let's say I put 100,000 into it at the wrong time. It'll chop that 100,000 in half and return 50,000 back to me. No, thank you. I'm staying away from the Tesla stock. This stock is on a free fall, and I think it's going to keep falling. There's just some big, big factors weighing on this company. And it is quite an advantage for Elon Musk to be so close to the current president. I would acknowledge that. But he's in a retail automotive business. And I think that at least close to half of the country does not like what he's doing. And he's very public about what he's doing with the federal government. Automobile sales are down substantially for Tesla, and I don't think they're going to recover because there's just a lot of competition from legacy automotive companies that have come out with excellent cars, EVs that are just really, really good looking cars. And you have new competitors coming out of China that are making really good product at a great price. So maybe in the US, Tesla will be able to sell their cars effectively. And I would argue they're not doing it currently, but I'll just say that maybe they can. But internationally, if Tesla has to compete against the Chinese, who have cost advantages, they've proven to be very good with technology, I think that the Chinese are going to come out ahead, as well as the legacy car companies like Volkswagen, Mercedes, Toyota. Those companies are great companies. Internationally, I think they're going to take it to Tesla. The Tesla stock has a market cap of $915 billion. It's a massive value stock. It was above $1 trillion for some time, but recently it's been really pulling back. The 1 year, the stock is up 40%, but for a period of time, it was doing quite well. Year to date, the stock's down 29%, and it looks like it's going to open down in the pre-market. Now, the forward PE is 100 for a car business. No, thank you. Car businesses are selling under a 10 PE. So why pay 100 for a company that isn't growing their revenue? Their revenue is flat. So flat revenue and some headwinds coming. That's what's really plaguing the stock price right now. Now, car businesses don't generate a lot of cash, and Tesla is right there with other car businesses. You have low margins, really low margin business, very complex business. You have to invest a lot of capital into the business. Just a lot of things that are undesirable in general. And the stock, therefore, is priced 87% too high. It's just they're two different numbers. Now, people invest in Tesla because they feel like they are looking at the big picture. And you know what? At times that really has worked on the Tesla stock. And that's not the investor I am. I'd rather really look at a company and have all things. I believe in the company. I believe in the big picture. I think they're phenomenal. I think they're in the right industry. And I get a discount. Where Tesla, the red flags that I have is I hate the automotive industry. It's a terrible industry. I don't want to own an automotive stock. And I don't want to own a stock where the cash flows are only 13% of the value of the company. That's just a bad decision that I would make. And I think Tesla is going to be a wealth destroyer for the next couple of years. Broadcom is a semiconductor company, and they have really flourished with the high interest in the data center. And revenues have gone up in the data center. Now, Broadcom, I believe, rode the coattails of NVIDIA. NVIDIA certainly just flourished. You look at the growth rate for NVIDIA, it's really, I'm awestruck. When I look at 100% growth on a big business, it's just phenomenal. Broadcom is not even close on the performance. They are growing through acquisition, which is interesting, but not as good as NVIDIA. Yet their stock was appreciating kind of in line with NVIDIA. And I think it's going to begin to correct. Broadcom has become a $878 billion market cap company. It has really flourished in the AI era. And the AI story is getting old. I don't think businesses are going to keep spending gobs of money to try to have the biggest data center in the world. Stock market is telling companies, you better bring down your CapEx or we will sell your stock off. And Broadcom has really flourished. Their stock price has tripled in that time, more than tripled. But when we look at the year to date, it has begun to correct, and the stock price is really falling. It's supposed to go down further when the stock market opens. Now, this stock is, the forward P is 29.5. That doesn't look too bad. The PE for 2024 was 145, which was ridiculous for a semiconductor stock. And again, when we look at the Broadcom growth, we need to keep in mind that they acquired a substantial business, VMware. So this is the addition. Most of this growth is the addition of a new business. It's not organic growth. If you look at the NVIDIA performance, that's our organic growth. That's phenomenal growth. This is not the same growth. This is acquisitive growth. So keep that in mind. The Broadcom stock has begun to correct, and the stock is still priced 47% too high. When I look at the free cash flows of the company, do a forecast, and then discount those free cash flows, the correction has begun, and I expect it's going to be a very quick path. We're seeing NVIDIA stock sell off quite dramatically, and Broadcom has really less value than NVIDIA, less momentum. And I think the stock's really, really going to go down quickly. And this is another stock that I need to avoid because this is going to be a wealth destroyer. And the final stock that I am avoiding because I believe it is going to go down in price and revert back to its intrinsic value is CrowdStrike. And I've been correct on CrowdStrike before. I shorted the stock in 2024 and made a very nice return. The stock has really gone up. And I think CrowdStrike is a quality company. It's not the biggest company in the world. But the cybersecurity space is a crowded space with a lot of competition. CrowdStrike really created a big customer satisfaction issue last year when it released a version of their software that made just about anyone who ran CrowdStrike software made their systems crash. That was terrible. So now if they have any other type of blip, you can see the stock price really get volatile. The stock has been selling off, and let's see how the fundamentals look on CrowdStrike. CrowdStrike has a market cap of 94 billion and it has a forward P of 95. It's an expensive stock. And the stock has seen some severe volatility. When they caused that big outage, the stock crashed. And this is where I was shorting the stock and I benefited from that problem. And I made a quick 50% on this stock, shorting it for less than 2 weeks. The stock has risen since then and has really gone past the previous valuation. The company is growing nicely, but I could show you 3 or 4 companies that are growing just as nicely within cybersecurity. So it's not overly impressive for me from my personal point of view. The revenue is 3.7 billion, which is very good. Based on the cash flows I expect from CrowdStrike, this stock is still priced 39% too high. And I believe it's going to revert back to its intrinsic value over time. This is giving CrowdStrike a very ambitious and optimistic forecast on their free cash flows. So this is another stock that I am avoiding. I think this one is going to destroy wealth, and I want to avoid CrowdStrike. The stock market really flourished for a couple of years, and I believe we've gotten to a period in 2025 where the stock market is correcting. It is selling off some stocks that had just too much euphoria, and the stock prices had gotten way too high. And year to date, a lot of these stocks, I think every single one recently, has been really selling off, and there's a long ways to go. Growing wealth is a matter of being able to shift from an investment that worked and is now overpriced over to investments that are going to work going forward. And I'm trying to shift away from stocks that look like this into stocks that are going to work. And there are really good stocks that are going to work for 2025. So that's my video outlining 5 stocks that I think are just priced way too high and can really threaten my portfolio and burn my wealth. So I'm going to avoid them. I'd love to get your comments on any of the stocks that I covered. Keep in mind, I'm just an investor sharing my opinion on these stocks. And by no means am I providing financial advice. I'm not recommending you buy, hold, or sell any of the stocks that I covered. And if there's a stock that you think is a really bad stock at this time, that is way overpriced, I'd love to hear about that in the comments as well. Thank you very much for watching. Good luck with your investments.